Chapter 16, How to Read, Analyze, and Interpret Financial Reports. In this video, we'll be covering 16.1, the balance sheet, a report as of a particular date. We'll be discussing the purpose and key items on a balance sheet, as well as how to complete a vertical and horizontal analysis of a balance sheet. First of all, we need to go over the accounting equation. This is the foundation for the balance sheet. The accounting equation states assets equal liabilities plus owner's equity. Remember, assets, how much the company owns, liabilities are how much the company owes, and owner's equity is how much the owner is worth. So the balance sheet gives a financial picture of what a company is worth as of a particular date. And it shows the accounting equation. Assets equals liabilities plus owner's equity. Assets, the resources of a company, the things of value that a company owns. And we'll look at some examples of assets in a moment. Owner's equity, how much the owner is worth. Liability, how much the company owes to other people, vendors, taxes, etc. So this is a balance sheet. We're looking at Moore Company. You notice that there is a heading here. This is a 3-line header, which is important to note. The heading gives the name of the company, the name of the report, and the date for which the balance sheet is presented. You'll notice that it looks like the equation. Your assets are on your left side equals your liabilities and your stockholders' equity. If you notice, we'll go down each of these briefly. On your assets, you see assets are broken up into current and then what is considered long-term assets. Current assets are things that are going to be due, or if it's a liability, due or give value in the current year. Long-term assets are going to last you several years, and long-term liabilities are due over 1 year. So if you're looking down the asset side, you see the current assets, things that they expect to convert to cash within 1 year. Cash is your total checking cash and checking accounts, savings accounts, and any cash that you have on hand. Accounts receivable is money owed to the company by customers for sales on account. Merchandise inventory is the inventory that we have bought that we plan on reselling, and we've discussed inventory when we covered the inventory and cost of goods sold chapter in this book. Prepaid expenses are company assets until they expire or consumed. So examples of prepaid insurance would be prepaid insurance. You pay for a year's worth of insurance in advance, and it will be valued to you through the entire year. So total current assets is the addition of all of these assets into one number. Plant and equipment are those assets that are going to last you longer than 1 year. You see building, and it has net. That shows you the cost of the building minus any accumulated depreciation that has been taken. Land is another asset that is going to last you for several years. So you get total plant and equipment. When you add total current assets and total plant and equipment, you get total assets equaling $205,000. On this side of the equation, you have liabilities. Your current liabilities are accounts payable, money owed to creditors for services or items purchased, salaries payable, obligations that the company must pay for salaries that have been earned but not yet paid. Those are the only two current liabilities within this company. So when you add them together, you get total current liabilities of $92,000. Moving on, we see long-term liabilities. Long-term liabilities are debts or obligations that they do not have to pay within the next year. There is one long-term liability on this balance sheet, which is a mortgage note payable. So it's the debt that is owed on this building that they purchased. So when you add your current liabilities and your long-term, you get total liabilities of $150,000. Down here in the stockholders' equity, we see we're dealing with a corporation because there is common stock. If this was not a corporation, if it was a sole proprietor, then you would see just owner's equity down here, but you see common stock. So it's the amount of stock that has been bought as an investment in the company. Retained earnings are the amount of corporation earnings the company retains, the amount that they have of net income the company has, less any dividends that have been paid out since the start of the company. This is not necessarily the cash balance. Notice cash is only $7,000 and retained earnings is $35,000. This is oftentimes higher because it's a cumulative amount over years. When you add these two numbers together, you get total stockholders' equity. Total liabilities plus total stockholders' equity equals $205,000. Your assets equal your liabilities and stockholders' equity. So you could put a double underline under these numbers to show that they are in balance and they equal. Your balance sheet, your total assets must equal your total liabilities and total stockholders' equity. So this example has us preparing a balance sheet for Long Print Shop for the following accounts: cash $50,000, accounts payable $38,000, merchandise inventory $14,000, Joe Ryan capital $46,000, and equipment of $20,000. So the first thing we want to do is look at this and figure out what types of accounts each of these are. Cash is an asset, accounts payable is a liability, merchandise inventory is an asset, Joe Ryan capital is an equity account, and equipment is an asset. So we want to start out with our 3-line header, naming the name of the company, the report we're preparing, and the date of the report. Next, on our asset side, we want to list cash of $50,000, then inventory of $14,000, and equipment of $20,000 for a total of $84,000. On the other side, we have one liability in the amount of accounts payable for $38,000. We also have one equity account, Joe Ryan Capital, for $46,000. $46,000 plus $38,000 equals $84,000. Our assets equal our liabilities plus our owner's equity. So, when preparing a vertical analysis of a balance sheet, there are 2 steps. The first thing we want to do is divide each asset as a percentage of total assets, and then round. Round each liability and stockholders' equity as a percent of total liabilities and stockholders' equity. Oftentimes, financial statement readers want to analyze reports that contain data for 2 or more successive accounting periods. To make this possible, companies present a statement showing the data for these periods side by side. This is called a comparative statement. So in looking at the vertical analysis, this is a comparative balance sheet. You see, you have your 2019 column and your 2020 column for Roger Company. So let's take a look at cash. Cash in 2019 is $22,000. Cash in 2020 is $18,000. When we're doing a vertical analysis, we want to divide each asset as a percent of total assets. So in 2019, our amount is $22,000 divided by $85,000 to give us 0.2588. In 2020, we have $18,000 divided by $81,000 or 0.2222. Then you need to convert these to a decimal. If you notice down here, the plant and equipment has a star beside it. When you divide this out, you may get a different number, but you need to round it so that it equals 100%. On the other side, when you're doing liabilities and stockholders' equity, we'll look at accounts payable. Accounts payable is $14,000 in 2019 and $8,000 in 2020. we'll be using the base of total liabilities and stockholders' equity of $85,000 in 2019 and $81,000 in 2020. So when we divide 14,000 by 85,000, we get 0.1647. And we divide 8,000 by 81,000, we get 0.0988. Please make sure when you're completing these analysis that you are dividing by the proper total. This 14,000 is divided by 85, and the 8,000 is divided by 81. They do not have the same base because we're talking about two different years. In preparing a horizontal analysis of a comparative balance sheet, there are 3 steps. First, you need to calculate the increase or decrease in each item from the base year. Then you need to divide the increase or decrease in step 2 by the old or base year, and then round as needed. So this is our same comparative financial statement. You see 2020 here and 2019 listed here. We'll then look at cash. Cash was $4,000. Make sure you're looking to see which is the old year and the new year. So our increase is from $6,000 minus $4,000. We increased $2,000. Our percent increase is the $2,000 divided by the old year, $4,000. We get a 50% increase. On the liability side, let's look at salaries payable. Salaries payable in 2020 was $2,900. In 2019, it was $3,200. Our change is a negative. It's a decrease. The total salaries payable went down. It was 32, it is 29. So 29 less 32 is a $300 decrease. Our $300 decrease divided by our base year 2019 of $3,200 gives us a negative decrease of 9.38%. Make sure you look at these to see the difference in when you have a decrease versus an increase.